are watching a master at work.
As we move through the second half of 2025, investors are witnessing one of the most resilient bull markets in recent history. The S&P 500, Nasdaq, and Dow Jones Industrial Average have all hit fresh all-time highs, driven by AI momentum, solid earnings, and surprising economic strength. But under the surface, cracks are forming. In this post, we'll break down what's driving the market higher, what could derail it, where we are in the sentiment cycle, and how you can position smartly for what's next. The technical picture. Bullish but stretched major U.S. indices are trending well above key moving averages. Our S&P 500 is plus 12% YTD and trading above its 50 and 200-day MAs. Approximately 74% of stocks are trading above short-term averages, a sign of strong participation, not just tech-led gains. However, multiple charts are showing signs of wave exhaustion, rising wedges, and RSI divergence, technical red flags often seen near cycle peaks. The fundamental engine, AI and earnings. The market's fuel comes from AI leaders like NVIDIA and Microsoft powering Nasdaq strength, earnings forecasts holding steady at 8% for 2025, labor market resilience, 147,000 jobs added in June, with unemployment dipping to 4.1%. Even small caps, Russell 2000, are showing life, joining the rally for the first time since February, a sign that the bull run is broadening. Seasonality, July's hidden edge. July has historically been a bullish month. Average plus 1.4% gain for S&P 500, plus 2.1% for the Nasdaq. But this comes with a warning. VIX volatility tends to increase in July, especially ahead of policy decisions or earnings season. Warning signs ahead. 1. Tariff tensions, July 9th deadline. President Trump's upcoming tariff decisions could shock markets. Escalations may disrupt sectors like energy, agriculture, and manufacturing. 2. Geopolitical flashpoints. Tensions between Israel and Iran are escalating. RBC warns that a conflict could spark a 20% S&P 500 correction, especially if oil prices surge and inflation returns. 3. Stretched valuations. The S&P's forward PE ratio is 20 to 22 stars, well above historical norms. This leaves little room for error if earnings disappoint. Sentiment cycle. Where are we? Based on over 30 charts and models, including Benner cycles, Elliott waves, and the investor emotion curve, we are likely in the euphoria to complacency zone. This is when retail investors go all in. Put-call ratios drop, breadth is still strong, but momentum begins to fade. When everyone is bullish, risk is highest. Frank Trey's strategy tips for smart traders. Take profits on overextended AI names. Watch for reversal candles near trendline resistance. Rotate into defensive sectors, healthcare, consumer staples, utilities. Track the July 9th trade news closely. It could shift the entire sentiment structure. Stay nimble and use trailing stops to protect capital. Final thoughts. The bulls are still in control for now, but the smartest traders aren't just celebrating all-time highs, they're watching sentiment, preparing for what comes after euphoria, and adjusting before the headlines catch up. Stay alert, stay sharp, and remember, preparation beats prediction.